I think the Fed has created bubbles across all asset prices. I'm not suggesting we're in a housing bubble, but we're damn close, I think, Melms.
Hey guys, Kristian here, coming to you with another new video on the current housing market and why the Fed is currently inflating the housing bubble by buying $120 billion in bonds per month, which includes $40 billion in mortgage-backed securities, and that's artificially keeping interest rates at all-time lows. So, where do we go from here? Do we follow the lead of Denmark and lower interest rates to 0%? It sounds like a commercial for used cars, right? Act now and you can get 0% down, 0 interest for 20 years on approved credit. My favorite line in the article is this: the once unthinkable notion of borrowing for 2 decades without paying interest comes as central bankers across the globe shy away from rate hikes. Which banks in their right minds would be willing to lend for 20 years at no interest? Oh wait, it's almost all the banks in Denmark. If you want to get 0% mortgage rates, make sure to smash that like button. I mean, come on, turn that like button blue. This video is only going to get better. You're smart enough to know what housing prices are doing, and that's even without major cities like New York and San Francisco with their falling values. The Case Shiller Index just blasted right on past all-time highs, and it's starting to get real, but this time it's different, right? Let's hear from the experts at CNBC on why the Fed is doing this. And as a bonus, at the end of this video, Jeremy Grantham is going to share with you how this epic bubble is going to burst and what you can do about it. But first, hit that subscribe button and make sure to ding that bell.
Mortgage rates at record lows. Our next guest is asking, though, if the Fed is propping up the housing market. Let's bring in Peter Bookvar, CIO of Bleakley Advisory Group and a CNBC contributor. Peter, you wrote about this in your note this morning, and of course we know that the Fed buys, what, $40 billion in mortgage-backed securities a month still, even with mortgage rates at low. So what is the Fed's role in all this?
Well, now we're seeing annual home price increases of about 7%, with CPI running at about 1.5%. That's obviously more than 4 times. So we're seeing home price inflation that's obviously being juiced by low mortgage rates. But we're at the point where the aggressive rise in prices is offsetting the benefit of lower mortgage rates. So there's really no win anymore to the low mortgage rate. And while it's lowering your monthly payments, that's being offset by the higher principal that you have to pay. In addition to, for that first-time buyer that's trying to save up for that down payment, you annualize 7% increases a year, there's a higher down payment that's needed. So I argue that the purchases that have compressed mortgage rates to such an extent where the Fannie Mae U.S. Treasury spread in January was about 1 to 2 basis points. It blew out to 70 back in March. And because of Fed buying, they basically compressed it now back to 0. But now that we're inflating home prices, we're at risk at hurting the market rather than helping it, particularly from that first-time home buyer.
How worried should we be about this, Peter? I'm asking this question because doesn't this ultimately correct itself? Buyers don't keep buying homes at 7% year-on-year increases. They cap it. And then people, or sellers, I should say, not just people, they ratchet down their sales prices. Doesn't this self-correct?
I hope that's the case. When you look out over the next 5 years in housing, the millennials are the biggest demographic powerhouse that is going to drive the housing market. Well, we have to make it affordable for them to buy. And that's not just on the mortgage side, but it's on the price side. So I would argue a healthier housing market would equate to a slower pace of price increases. But the Fed is going to have to explain themselves that with these sort of price increases that is potentially pricing out that first-time buyer. And as you mentioned earlier, Toll Brothers CEO saying that buyers are getting sticker shock. The Fed is going to have to tell us why they think it's a benefit to the market to be buying $40 billion a month in mortgage-backed securities still. And that they own more than a third of that market. They're at risk now of Japanifying that market. By dominating that market to such an extent, it scares off private buyers, and they sort of break that market in terms of its functionality.
Peter, it's the same as the Fed buying high-grade corporate debt. Why are they buying Apple's debt? So I'm totally with you on this, and I think your thoughts are always right out in front on this. What's the next asset that they're targeting? because we're creating the mother of all housing bubbles. We're creating arguably a stock bubble. And when do they get comfortable with what they've done to asset prices, even if they claim they have no inflation?
Well, we'll know for sure next week, because there's obviously chatter that, at least on the Treasury side, that they're going to extend out the maturities of their QE5, I call it. But if they sit and do nothing and they just leave it as is, maybe that's their first sign that, we've done enough for now. And I think in 2021, because we keep in mind, what they're doing now is a COVID world. Next year, we obviously hope is a post-COVID world with that vaccine. So how is the Fed going to substantiate doing the same exact policy next year that they were doing this year? And ironically, for a while, the Fed was saying we hope to transition our portfolio to a Treasury only and away from mortgage-backed securities. And then obviously the first hint of trouble, they're right back in diving into the mortgage-backed security market, to the point that they're dominating it now more so than they did in the early, in 2010.
Just quickly, Peter, what are the odds in your view that the Fed doesn't expand the amount of assets purchased, but simply shifted away from mortgage-backed securities to longer-dated treasuries?
I think you hit it right on the head right there, that is what they will likely do if they do something. They are not going to be increasing the size of it, but recalibrating it is definitely a possibility, as you speculate.
All right, Peter, great to speak with you. Thank you.
Thanks, Melissa.
Peter Bookvar, I know we use the term bubble fairly loosely, but Guy, do you think this is a bubble in that homeowners have more equity than they did in the past housing bubble, to the point where they wouldn't be in trouble if rates went higher?
Yeah, it's interesting. I'm not going to go that far, but what I will tell you is there's clearly the Fed is creating a bubble in asset prices across many, many different things. I mean, just look at what's going on in Bitcoin. Look at there was a secondary priced by MicroStrategies, I think, and the sole purpose of that secondary was to buy cryptocurrencies. I mean, if that's not a sign of excesses, nothing else is. So I think the Fed has created bubbles across all asset prices. I'm not suggesting we're in a housing bubble, but we're damn close, I think, Melms.
What happens, Steve, to the housing trade broadly, as we've talked about it, whether it be furniture sellers or hardware stores, et cetera, if mortgage rates tick higher, the Fed steps away and allows mortgage rates to go up?
Oh, without question, all of these stocks come in. If you look at Lennar's up 29%. All of these names are up between 20 and 40% if you look at the housing market. And even Home Depot and Lowe's, when we were in the throes of COVID, there were lines around the street at my local Home Depot. So there's a lot that was pulled forward. If rates increase, now let me give you one caveat. Every housing recovery happens in a rising rate environment. But this is not a housing recovery. We pulled forward a lot of that demand. So I think a lot of these stocks come in dramatically.
Wow, that sounds like a stark warning from the fast money folks at CNBC. And everyone is aware that there is no way that interest rates would be this low if governments from around the world weren't manipulating them and inflating the mother of all bubbles. This million-dollar question is, when does the stimulus end? And how does the epic bubble burst? As James puts it, these great bubbles are where fortunes are made and lost, and where investors truly prove their mettle. For positioning a portfolio to avoid the worst pain of a major bubble breaking is likely the most difficult part. Every career incentive in the industry and every fault of individual human psychology will work towards sucking investors in. The world economy has been shut down for almost a year, and we probably have 6 to 9 months of difficult times still to come. The bubble may continue to inflate a while longer, and Tesla stock may hit $1,000 per share, while Bitcoin goes over $1 million. But my bet is that there are some challenging times ahead in 2021 and well into 2022. Please leave a comment down below so that we can figure out when this bubble's gonna burst. And if you haven't already, please make sure to smash that subscribe button and also ding that bell notification so that you get notified when we release great videos just like this.